Okay, I'm going to explain here the difference between economic and accounting profits. The best way to explain this is by using an example. Say that you actually have you're working right now, let's say Blockbuster, or, well, there's no Blockbuster anymore. Let's say you're working at McDonald's, you're bartending, and you're making about $1,000 per month. And this is the salary you're making right now. Now, say that instead of working, the other thing you're contemplating is to open your own business making t-shirts. And you're going to sell these t-shirts in the corner. Now, you can sell these t-shirts for about $10 each. And let's assume for t-shirt. And let's assume that you are actually going to be able to sell about a quantity of t-shirts, let's say 100. So you're going to make a revenue equal to 100 times 10, which is $1,000. Now, one thing that you want to find out is, well, how much profits you're going to make. Well, there's two ways we can calculate these profits. An accountant and economist will calculate these profits differently, which is the whole point of this example. So first, let's consider an accountant. So an accountant will calculate your profits in this way. Well, the accounting profits for an accountant will be, well, the revenue you make minus the accounting costs. And these accounting costs are what usually we have by cost, what we usually understand when we say cost. In the case of the example, it could be something like, let's say, $800 for ink, materials, and all that stuff. So that's your cost will be, let's say, your accounting costs, and that's materials and other things. So now an accountant will calculate his profits in this way. Accounting profits, called that AP, is going to be the revenue, which is $1,000, minus the $800 in accounting costs. So you go to an accountant, he will tell you that this business will make you $200 in profits, which sounds pretty good, but it's quite different than how economists will actually count your profits. So how would economists do it? Well, here's an economist here. What the economist will do is say, well, your revenue is the same, the difference is in your cost, and the economist will in fact account your accounting costs, but he'll add something else. So the economic profits are going to be equal to your revenue, yes, minus the accounting costs. But the economists also add something else to the equation, which is the opportunity cost. All right, so for an economist, costs are two types. One is the accounting costs, but also the opportunity costs. And what does the economist mean with this idea of opportunity costs? Well, in this case, the opportunity cost of having this business will be, well, you guessed it right, it's going to be the $1,000 you won't be able to make because of your business. If you did not have your business, you can work for McDonald's or bartending for $1,000. If you work on your t-shirts and sell your t-shirts, you are giving up that $1,000. So that is an inherent cost of selling t-shirts. So an economist will count that. So to calculate economic profits, call that EP, the economist will take the revenue, which is $1,000, minus the $800 of accounting costs, minus the $1,800 of opportunity costs, and you will end up with a negative profits of $800. So you end up with losses. It's quite a different solution or result than the accounting. So the important thing here to remember is that when you talk about economics, the economists usually include your opportunity costs in your total costs. So economic costs are going to be made of traditional costs, which we're calling here accounting costs, plus the opportunity costs. Seems like a simple enough idea, but you see in this example the dramatic impact it could have in an analysis of your business, particularly for decision making. But it will get a little more complicated when you do some of the examples that you see in the quiz today, and the quiz this week, and also in the pop quiz. Hopefully this will make it more clear for you.